before you go over the regressions and the rankings, can we go over the performance reports?
No.
Can we go over that? Can we do the market cycle?
Yeah, we're on talking about the real estate and asset, the apartments and office.
What do your notes say? Where did we leave off?
You're talking about portfolio. Oh yeah, portfolio. Yeah, portfolio construction.
Oh, portfolio construction methodology?
Yeah.
Got it. Is that where I ended? Awesome.
You did.
I can review some of this. All right. So now we're going to build a portfolio. So what's the goal? The portfolio construction process starts with a detailed research and testing plan to determine data, forecast, selection models, dependent and dependent variables, results of the analysis assist in forecast variable selection, market rankings, and total return forecast. The final stage is identification of geographic and economic-based portfolio diversification or concentration reflected in the metro weights and target allocations. Did we actually go through that? So here's the methodology plan. So the first thing I needed to do was go out and find the models, not only forecast models, but the selection models for ranking purposes. Then go out and do an inventory of the data, find out what data I had available, what data I had to purchase. Then I had to test the variables within the models to see which ones they worked, that worked. So there was a regression forecast model that I had to test the variables, and then there was a selection model. And actually the forecast model variables were also helpful in building the selection model. And what I liked is I liked to use two different types of methodologies and then rank the results. And if the two methodologies have basically similar rankings, it's meta-analysis, where I'm getting validation by using two different methodologies. Then I produced the metro return forecast and the rankings. Then we went into geographic diversification, which is the main diversification strategy. But I was concerned that if we were diversified geographically, we could be concentrated economically. So if I have a huge portfolio in Silicon Valley and I have a lot of properties and a significant portion of the portfolio is concentrated on the east side in Seattle, I diversified geographically, but not by economic concentration, because those are two high-tech clusters. So I'm not getting any economic-based diversification, I'm getting geographic. But I wanted to have both geographic and economic-based diversification in the portfolio, okay, which was new for the management team to hear. Then I come up with the metro weights, and then the target allocations, which you're all familiar with. I built basically two models, a quant model and a qualitative model, and then a hybrid model between the two. I used cross-sectional regression methods, so these were the factors, and I was forecasting either returns or rent growth were the key to dependent variables. I used z-scores. Z-scores are when you, let's say I have a sample of 14 metros, I got employment growth forecast for the next 5 years for each of the metros. I'm basically going to take the actual employment growth for, let's say, LA, minus the mean for the whole sample, divided by the standard deviation, I get a z-score. These are standardized scores. So I can do that for employment, population, and all kinds of things. And then I can weight them. I can weight the z-scores and create a composite score, and then sort the metros. And the metros with the highest scores for the underlying fundamentals will rank to the top. And the ones that are weak will rank at the bottom. So z-scores are extremely powerful tools in creating indexes and ranking markets. So I went through the literature, data sources, correlation analysis. I also used a data mining tool through SPSS called stepwise cross-sectional regression, or stepwise regression. It's a data mining tool. Most academics don't like it very much, but from a practical standpoint, it's very useful. because I can go into the literature and look at the variables that have been used before, and then basically just take a kitchen sink of the variables, throw it into the regression optimization model, and what it'll do is it'll put combine the variables, and basically it will come up with the combination of variables with the minimum mean squared error, which is your error term on the back end of your regression. So it minimizes the mean squared error through the combinations of the variables in an optimization approach, so a machine approach. So it's just data mining. But what I found out is a lot of the variables that I came up with by interviewing management, the variables that I came up with through the literature and through the data mining, there was some overlap between the variables that just confirmed that the variables that were mentioned in the literature by management and in the data mining process were the most significant variables that needed to be in the model. Okay? And then practical experience, I interviewed the management. I think we went over this. So the 4 variables that were the most statistically significant in forecasting housing demand was number of persons per household, home price appreciation, income per household, the inflation rate, and employment growth. Those were demand factors. And then on the supply side, it was inflation, consumer confidence, absolute change in GDP, change in home prices, interest rates, and housing affordability were the best predictors for the supply. And by getting these, total housing demand and total housing supply, I could calculate the share of total housing demand and supply for apartments. Okay? So I could drill down into our market. And then the weighting for the scoring system, these were control factors. These were the demand factors, mostly employment, obviously. And then supply factors, I developed some supply metrics and then gave them weights. Okay. From these weights, I calculated the z-scores for all of these variables for each of the metros, weighted them, calculated the weighted z-score, and then re-ranked them, okay, the metros. So the results of the research were that the top target markets for investment were LA, San Diego, Seattle, and the Bay Area. The worst markets was Las Vegas, Albuquerque, and Portland. So when management saw this gave them a research-driven justification to sell off the commodity markets and redeploy, $1 billion into these fundamentally stronger markets. So through the research, justified the reallocation of capital from weak markets, commodity markets, into strong, supply-constrained, tech-oriented markets. I also ran, looking at sub-markets, I wanted to drill from, once you know what metro areas you're going into, then you want to know what sub-markets you want to invest in. So I had about 160 sub-markets in the western region, which is a pretty robust sample. I think maybe even 300. So I basically ran a bunch of correlation and regression analyses on some variables, both from the literature and management. And these were the variables that were the strongest predictors for rent growth at the sub-market level. So occupancy, structural occupancy rates, renter-occupied households, incomes, change in households, new construction, population, in professional occupations. So high home prices, high executive occupations, that's where you want to be building because they can, people can have more money to pay more rent. Okay? And then over here, structural forecast occupancy rates, inventory, population households, occupied households, populations of occupations, and median household incomes and home values. So as you can see, there's some rate correlation between the two different approaches. One was using regression, the other was using correlation, and then I basically took the variables that came up the most in the two and put together my own model to predict rate growth. And then we basically took those variables, weighted them, scored each of the sub-markets, and then plotted them and ranked them. But before I did that, that was the quant model. Then I created a survey and asked senior level management about every single sub-market in all the metro areas that we were in, and said, give me a Likert score between 1 and 5 for each of these questions that I asked you, and then what I could do is I could weight these Likert scales, or I could just sum them up and re-rank the submarkets using the survey scores. I liked it because I used survey and I used quant and married the two together. And if there's, if I'm getting high qualitative scores and high quant scores for certain submarkets, then I know for a fact that those are the submarkets that are the best submarkets in those areas. So we're looking for markets that are up here that have high survey scores and high quant scores. We would be looking at these, but we'd have to do a little bit more due diligence. And then these markets down in here that were low would be opportunistic, or we would totally avoid altogether. So that was what they asked me to do, because they had never had a researcher on staff, a director of research, but to attract institutional capital into the REIT, because we were looking at becoming a $5 billion REIT. The institutional investors require that you have a research-driven strategy and you have a research director with, master's degrees and experience in doing this type of modeling. Okay? You can't just say, I feel or I think, that San Francisco is a good market. It's like, prove it empirically. Okay? So here were the submarkets, and this totally makes sense. Mountain View, Los Altos, Central San Mateo, Russian Hill, Embarcadero, Sunnyvale, Marina, Pacific Heights. So these were our target markets. So our acquisition team and our development teams, basically we said, these are the markets that you need to go target. You can look in these markets right here, but you're gonna have to justify it. And if you bring us any deals in these markets, you're gonna have to raise the discount rate, or lower the expected growth rates, or why are you bringing us deals in those markets anyway? Because they're not Class A submarkets. Okay. And then we thematically plotted, they had no idea. They didn't have a research-driven strategy before. So they were buying properties in locations across the Bay Area with no strategy, just based on IRRs and MPVs and stuff like that. So once we built the thematics and then plotted the properties that we had already purchased, you can see that the majority of them are in red or orange. There was one that was in Vallejo up there, one that was way in San Rafael, though that's probably in orange by now. And then Hayward, this was our Hayward property next to the Hayward BART station. So even though it wasn't in an orange, we were actually able to get transit-oriented development or infill type of characteristics from the property, even though it was in a commodity market, because we were less than a mile, or actually we were right next door to the Hayward BART station, right? So it only took you what? How long to get from San Francisco to Hayward and then walk right into your unit? So you can buy in some of these tertiary markets if they're next to hospitals or airports or trucking terminals or long haul transportation nodes. You could probably justify it, but you're gonna have to underwrite it a little bit more critically.
Was it diversified in the product type too?
Yeah, actually most of the product was about 100 units to 250 units built after 1980 in most cases. So it was quasi-institutional. We had some smaller stuff. Like one of our buildings that we had in Palo Alto, or on Sand Hill Road in Palo Alto, we bought it for, I don't know, like I think we bought it for like $15 million in like the early 80s. And the thing at one point, when I got there, at some point it was generating 15 million, right, a year. So at some point, the land values get so high. But mostly, garden style, podium apartments. And then we looked at market cycles, because the real estate investors always look in cycle. Where are we in the cycle? Should I sell at the peak? Should I buy at the bottom? What markets have the best cyclical characteristics? So what I did was I basically took the 14 metros and then categorized them between supply constrained and supply unconstrained, and then ran some metrics on it to see if there's some underlying inherent characteristic about supply constrained markets as a justification to buy in these markets and not in these markets. And what we did was we found out that in supply-constrained markets, particularly from peak to trough, so when you go from peak to trough, that's an integral in calculus. So the rents that you're banking, you're collecting it longer over the cycle, except for 4 years. In the commodity markets, peak to trough goes in 4 years. In the supply-constrained markets, it takes 7. So we're collecting more rents under the curve longer in supply-constrained markets than in commodity markets. So that, again, was just a justification to get into supply-constrained markets. And the two quintessential supply-constrained in commodity markets was LA and Las Vegas. And you can see that peak to peak, it was almost double. The cycle was almost double peak to peak from LA to Las Vegas. Almost double trough to trough. Almost double peak to trough. And basically 2/3. So again, it's like we should be in LA, which we did. We eventually did go to LA. So optimization, determination. Using the forecast variables, constraints and assumptions, the geographic diversification model and optimal weights were determined using total returns produced from the forecast model and subjective constraints imposed by management. Management basically said, okay, we want a minimum of this amount in this market and no more than a maximum amount in this. Just like you did on your passive portfolios where we set the minimum maximums. And then active and passive portfolio optimization strategies together determine the total target portfolio by Metro. So that's what you're doing in this class. So you came up with your passive, then you came up with you're going to come up with your active, and then you're going to take your passive and your active along with any fundamental or technical analysis, and you're going to basically set the target allocation. That will eventually, then you'll back test, and that'll be the one that you recommend to your client. So the total return forecast model, again, we did the literature review, we tested the variables using correlation and regression, and we found out that total affordability, permits to household ratios, age cohorts for renters, and employment were the most statistically significant independent variables to predict the returns for the different metro areas. We also looked at just a simple regression model, just using employment. We found that employment basically captured almost 70% of the influence in the forecast model. So really demand is the #1 driver of returns. When we added in the supply side factors, as you can see, the model fit very nicely around the actuals. Okay, so that made us feel really good. And then we basically tested and ran the regression models and forecasted the returns for each of the metro areas using the regression based on the variables that we came up with. And then we back tested the forecast model based on rankings over a sample time period and said, hey, the model was forecasting a high return for the Bay Area. We looked at actual returns, did a good job. We looked at rent growth, which was pretty correlated, and we looked at occupancy rates. And you can see that in 1996, the rent correlations were really high. Not as high in 95, but really high. The Pearson rent correlations were really high here, and they were actually pretty high here too. So we felt pretty good that the model was doing a good enough job, not necessarily forecasting nominal returns, but relative returns compared to the other, the sample. And then we took those rankings, and we created a rank band, or a correlation rank band, to show that the model did a good job of predicting the other variables based on ranks. Okay, so I thought that was pretty innovative. So the active portfolio indexed approach. So the first thing we did was we identified our markets. We were going to focus on California. We had our forecast variables. Management set the minimum and maximum for the metro areas. We had our targeted income and appreciation returns and our target return, which was 12% was our hurdle rate. Then we forecasted the returns for the 14 metros that we were looking at. We calculated the covariance matrix, which is exactly what you're doing right now, and basically running the optimization that will kick out the portfolio allocations up here using the active approach. Then we went to a passive approach. Let's skip past this. Where we said, okay, let's just build an S&P 500 model, okay, like an ETF index, but for apartments. So what we did was we found the effective rents, average effective rent for each of the metros. We got the occupied units, so we multiply the effective rents by the occupied units, and we get the operating revenue, okay, for the metro. Then what we can do is we can take out the expense ratio, and we end up with our, multiply the revenue by the expense ratio to get the operating expenses. We take the revenue minus the expenses, we get the net operating income by metro. Sum it up, divide it back, boom, we get the passive weights. So the Bay Area made up 33% of the index, 25% in Southern California, 9% San Diego, 9% Denver, 5% Portland. So this gave us kind of an idea if we were to replicate the index, like an S&P 500 approach, these would be the passive approach that we looked at. They thought it was interesting that LA was so big, but LA is so big. That's one of the, the Bay Area and LA are so big. That's why they have such huge weights. But this was pretty compelling to them. It was like, oh my God, the majority of the inventory is in LA and the Bay Area. Why are we in these other secondary markets? We shouldn't even be in those markets at the end. So then what we did was we looked at, I basically looked at net operating income going forward for our portfolio, summed it up, divided it back, and got the weights. So this is our forward-looking net operating income allocation for our portfolio. Then we came up with our target portfolio allocation, the index passive approach, and then just calculated the difference between the two to see the variances. So very quickly we could see that we were underweighted in Denver, although we didn't really like Denver because it was commodity. And we were underweighted in Portland. Portland's a really small market, we didn't care about that. But we saw that we were significantly underweighted in the Bay Area and in Southern California. And these were the ratios. So if it's less than 1, you're underweighted. If you're near 1, you're equally weighted. If you're over 1, you're overallocated. So very quickly they could see the weighting. And then what we did was we decided that we wanted to, that the target portfolio, our eventual target portfolio, we wanted to go from a $2 billion REIT to a $4 billion REIT. Okay, so we want to get to $4 billion in the next 5 years. How much do we have to buy per metro to get to that allocation? So what we did is we looked at our actual net operating income. Okay, we looked at we took the target allocation, target net operating income, and we basically, this is the target right here. So the target net operating income multiplied by the target percentage is going to give us the target NOI by metro. Okay, so we got our actual and we got our target. Okay, so then we can calculate the variance of the net operating income. So where are we over and under concentrated? And then what we did was we took the net operating income per market and divided it by an average capitalization rate, or income capitalization rate, or a discount rate, to get net asset value. Then we took the net asset value and divided it by the price per unit, or the price to construct a unit in that market, to get the number of units that we needed to buy, build. Divided those units by 250, because then most of our communities are standardized, they're around 250 units per community, basically told us how many units, but also how many communities we needed to buy in that market to reach the target allocation. So we needed to buy 10 properties, you know, and Southern California for $39 million. 3 in Seattle, 7 in the Bay Area, 3 in San Diego, 0 in Salt Lake, 3 in Sacramento, 1 in Portland, 4 in Phoenix, and 6 in Denver. They said, yeah, we're not gonna forget those markets because they didn't rank really high on the score sheet. So what we're gonna do is take the capital allocations here and redeploy them up into the Bay Area in Southern California. And we're gonna sell off these markets and then redeploy and go further out on the efficient frontier and over-concentrate and over-allocate in the Bay Area in Southern California, which was brilliant, actually. And when they did start selling off the commodity markets, the cap rates had compressed and the values had peaked in the commodity markets, so they were selling off the commodity markets at the peak of the cycle. It was pretty brilliant. So once you build the portfolio, you got to track it. You got to track the markets, you got to track it. So you built these dashboards. These are all computerized now, but you know, I basically produced these quarterly books and gave them to the investment committee and senior management on a quarterly basis to basically monitor the underlying fundamentals of the markets, not only the economics, but the demographics and the underlying market fundamentals. Not only at the metro level, but also at the submarket level. Okay. So we were granulating, and actually I was in the process before I left of developing metrics at the actual property level and start scoring the properties at the underlying property level, and then build an automated valuation system that would, on an annual basis, would automatically revalue the property on an annual basis or quarterly or monthly, so that the properties are constantly being valued like stocks are, you know, as they're being valued every single day. So I was trying to replicate a stock market portfolio model. And then you want to measure performance in your portfolio. So what I was doing was looking at actual to updated, actual to static, actual to benchmark for occupancy rates and rent growth. And I was looking at the variances. And the question was, well, in how many instances here did we outperform in rent growth or occupancy against these benchmarks? And based on the number of positive variances divided by the total sample, our occupancy rate performance was like 99% positive. We were 60% positive in rent growth. And then positive variance measurement was about 42. So we did this for, we updated this every quarter to be able to track our performance as we were managing the portfolios, benchmarking to the market. And then you have to do an annual hold sell analysis, looking at actual to market IRRs. You know, are we getting a higher rate of return than the market? If we're not, then we should probably sell the property. Are we getting actual higher income returns than the market? If we're not, we should probably sell it. Are we getting higher net present values than the marketplace? If we're not, we should probably sell it. And then, you know, is the market price of our properties well above the replacement costs? Okay, because we want to have that premium. Okay, so as a way of making decisions. So once you've built the portfolio, now you have to, ideally, would be to, because it's really expensive to sell real estate, and it's really expensive to a certain degree to sell off assets within your portfolio. Maybe the stock goes down and it's underperforming, where you just don't throw it out if it's got underlying fundamentals, maybe in some kind of cyclical correction. So once you build, and real estate's really expensive to build these portfolios, so to sell off pieces of the portfolio and then have to buy back the transaction costs and the opportunity costs are huge. So that was basically the motivation to build these transaction-based indexes for property derivatives trading, so that you could short the real estate market and hedge off the value declines or the income declines in your portfolio by writing the contracts. Okay? And using modern hedging strategies, derivative strategies that the fixed income and the equity players take for granted. So the objective was to develop a pure price commercial real estate indices based on closed transactions. Most of them were appraisal-based, or valuations, at the national, regional, and sector level. Provide industry with tradable indices used to trade commercial real estate-backed derivative products. This was hard, because nobody really understood what derivatives were. Fixed income and the equity people understood, but the real estate never heard of derivative contracts or modern portfolio theory using derivatives, because they're not corporate finance quant people, they're real estate dudes, you know, in boots and stuff like that. They're dealing with the real estate, they're not dealing at the capital market level. And the methodology needed to control for data spikes while allowing the indices to reflect the underlying real estate investment and space market fundamentals. Our problem is that data would come into the index in random portions. And if all of a sudden you had a bunch of high-priced transactions that occurred in one quarter, once they hit the index, your index is going to spike. So you needed to control for some of the spiky aspects associated with the indices, because the institutional investors do not want high volatility in their indices. Okay? They want some volatility, but not a lot of volatility. So we came up with 10 indexes: a national composite, office, warehouse, apartment, retail sector indices, and then 5 geographic composite indexes. And then we could take these to, 20 sector geo group. We could go to 10 to 20 to 40 to 80 and start creating custom indexes within the data analytics division, here within the company. So we were moving towards an index development shop, okay, like S&P. We were basically partners with Standard & Poor's. So index research and development. So here were the steps that we had to go through. So we had property sector and size determination, data tests for normality and filtering out the outliers, actually calculate the indexes, do analysis and applications on the indices to actually show that you could forecast them, and they actually tracked real estate. And then working with Wall Street to develop the exchange-based and over-the-counter property derivatives. So the transaction data was key. So we went to multiple sources. We were spending like $150,000 a year on data to get all of the data sources. I could have probably spent like, $250,000, $250,000 to get all of the data. And then what we did is, because commercial real estate transactions are not as robust as residential, we had to group metros to basically get enough samples, large enough samples to be able to calculate the indexes. And then what we did is every property transaction that came in, we coded it. We coded it by property sector, we coded it by property type and quality class, all the way down to the zip code level, and back up to the county and the metro level. So there was a lot of coding. And then there was data that was coming in from prior months. This was like a capture period in which we were capturing the data. It took us a month to data process it. We actually calculated the indices 1 month before they were actually published by Standard & Poor's, which was the publisher. Okay. So what I'll do is I'll get into, Thursday we'll do the index methodology, and I'll get into mathematics. How do you actually construct this? Okay? Yes. Yeah. Anybody need any flyers for Thursday nights? You know any friends that want to come to our event? Can you pass it out? Oh, you don't know. For 5 years? Okay, that's fine. I'll just extrapolate some data. Just plug in the price and just back forecast. Just plug in some prices, so it fills it in.
Okay.
You know what I'm saying? So if it's been going up,
Yeah.
constantly, then just go back in time, so that it just fills in some data. It won't make it very. Yes, Sam, what's that?
Yes. Oh, you maybe didn't get it or whatever, so I'll check it in.
You been doing, do you have a job yet? Yeah, we got it. What about fall and after?
I don't know.
I think you need to yell at those guys.
I know.